Hi everyone, welcome to the Accounting and Tax Helpdesk podcast. Today we're going to talk about what we should do after the tax season after April 15. So, when you file your taxes, the first thing you should consider first before filing it, if you prepare a return or if a professional prepared a return, you need to review your tax return. There is always room for a mistake. The CPA's professional makes mistakes, and mistakes part of the human being life. So, and CPAs are not excluded. The good thing about if the CPA makes a mistake is there is a way to amend it. It's not like a surgery that if there is a mistake, you may lose your life. So you can just amend your return. But what mistakes could happen, we can talk about it in the future. But always take a look at the return, see what's going on. Just don't look at the input, look at the output, and then make sure everything is correct. After you file your return, then there are a lot of things you need to consider. Did you pay too much? Did you pay less? Did you overpay? Did you underpay? All of things we're going to talk about in details, but these are the things you need to make sure you consider. Okay, if you know the extent of the work that the CPAs do and then the number of the clients they work in the tax season in the short period of time, so you would consider reviewing your tax return. They're constantly working with different clients. They work with a huge volume of work, so there is always room for mistake. Even the larger CPA firms, that there are different layer of the work, there are a lot of mistakes happens. Like if the time the return transfer to the admin work, there might be a mistake happens. So there is always you should always review your return. At least you make sure your name on the tax return is correct or your address is correct. Um, so always review return. Make sure that all the information that you know is included in the return. CPAs like their clients, but they don't know everything about their client's life because they have a lot of clients. Like for example, you got married or you had a child and you forgot to communicate with your CPAs, but you always think, oh, he already knows. He doesn't. Sometimes they don't know these things. So you should always review your tax return. Make sure none of these excluded from your return. If you got married, if you got divorced, so always review your tax return. There might be a mistake in the mathematical, like they added your, for example, your income is 57,000. They put 75,000. So all of these mistakes might happen. So review your tax return. There are a lot of mistakes might happen. So CPA knows whatever you told them. If you told them you got married, they know about it. If you told them you had a business, side gigs, everything, then they know about it. They automatically they wouldn't know. So whatever you told them, they know about it. So if you talk to them, communicate more with them, they would have a better understanding of your situation. So a lot of things happen after the fact. First thing is missing the income. Like for example, psychic income. You work somewhere, and then that people issue a 1099. You receive a 1099 that you haven't reported the income. You have investments in mutual funds. You think, oh, I didn't take any money out, so I don't have any income or any taxes. But you receive a 1099 that you have to pay taxes, or your financial advisor invests for you, sell your stocks. You don't know anything about it because all of your money stay in your investment account. You don't take any money out, so you don't see the actual money, but your investment's making money, and then you have to pay taxes. And then how IRS knows that the 1099 would be issued. 1099 W-2s, everything is when it's issued, the IRS knows about it. So all of these areas are that sometimes after the fact, or you miss the deduction, you miss some credits that you didn't know about it. So always review, always double check, have a conversation with your CPA and go over your tax return before filing. So if you receive the 1099, if your income is your expenses, basically you receive a 1099, but your expenses cannot cover the whole income, but you still like a less than the limitation, you would have to file your taxes. Let's give you an example. If you have a salaries, W-2s, and you make 14,000, because the limitation for filing taxes is 14,600. That's the standard deduction. You don't need to file taxes because you earn less than 14,600. But if you receive a 1099 for 14,000, and then you have expenses like 5,000, so your net income is 9,000. You think you don't need to file a tax return, but you do, because you're excluded from income tax, but you're not excluded from payroll taxes, self-employment taxes. Self-employment tax are those like taxes that you pay for Social Security and Medicare, and when you're a W-2, they already automatically deducted from your payroll. But if you're a 1099, you have to pay those taxes on with the tax return. So unlike W-2s, that if you make under certain amount, you do not required to file your taxes. For 1099s, if you income, you have to pay some payroll taxes, and you have to file your taxes. How long you need to keep your documents? So it's all about the statute of limitation. Like for IRS, it's 3 years. And then if you receive a 1099s, W-2s, it's good to keep them for 3 years. Electronically or physically, that would be fine. But if you are self-employment, I would recommend to keep your records, those expenses, for 7 years, because there is a possibility that you get audited and then go beyond that 7 years, just to be safe. 3 years is a answer for statute of limitation, but for self-employment, I would recommend to keep your records for 7 years. So if you have you don't want to keep all of those receipts for 7 years, that's a lot of receipts and papers. You just need to keep a digital copies. So you don't need to keep all the physical receipts, just keep the digital receipts. There are a lot of apps, softwares that can help you with that. Just organize your tax documents and then all of those receipts. So you don't need to keep all the physicals. You don't have that room. Nobody has the room these days. So the digital copy would be fine. So the situation happens, and then first thing, you shouldn't be surprised. If you have a good strategies, you should never surprise by April 15th. You should always know, okay, I owe this much, about this much. April 15th, I don't owe anything. So if you're surprised, if somebody asks you how much you owe, and then you say, oh, it might be 40,000, it might be 4,000, so it means you're not doing something right. You should always know about, okay, how much you owe, how much you don't owe. And that's happened with the tax planning or just communicating with your CPA. But let's say it happens, and then for example, you owe some amount. It means first thing, hopefully you don't pay any penalties. If you pay penalties, means you haven't made estimated payments enough. There is another way to look at it. If, okay, I make my estimated payments, I don't need to pay any penalties, but I still owe IRS by April 15th. That's not a bad strategy, because you're not paying penalties, and then you just defer the tax payment to the last minute, and you're not surprised about the amount. But let's say you were surprised, you owe a lot of money. It means two things. One, you didn't have enough withholding if you're employees, or you didn't make estimated payments based on your income. So if you underpaid, take a look at your withholding. Talk to your CPA what you need to do. Do you need to make estimate payments for the next year or not? On the other hand, if you're overpaid, it's not a good thing. Some people file with the IRS and thinks like tax return is source of income. Whenever they call CPA, oh, I need to travel, I want to file my taxes to get money. So it means they just overpaid during the year. It's not the IRS pay the money, they just withhold a lot of money that they didn't need to. So if your refund is a big amount, means you're overpaying to the IRS. The money that you can keep for yourself and then pay to the last minute to IRS. That's the best strategy. So if you're underpaid or overpaid too much, you need to talk to your CPAs and change your strategy. W-2 employees are not getting a refund. They cannot write off the other expenses. The reason they get a refund because their withholding is not correct. For example, if they receive a paycheck for 3,000 and at the end of the year they receive a refund for 30,000, means each month they could have got that paycheck for maybe 4,000. So that means just the amount you take home each month would be higher. So if you get a big refund, means you don't have to withhold that much money during the year. You get more. The paycheck would be higher during the year, and then at the end of the year you might owe a little or overpaid a little. That would be the best strategy. But if you just overpaid 20,000, doesn't mean the IRS is your friend and pay you money that because they like you, because you just withhold too much money from your paycheck. You just already paid them too much. This is your money. So when you get a refund, that's the money you already paid. It's not the money that IRS say, oh, I want to help this guy, and now I pay these payments. And then so the tax return for some people that thinks it's a source of income and they rely on it, it's not. They withhold, they put too much money in the IRS. And at the same time, if this year you made the overpayment, don't expect the next year you get a refund too, because your situation may change. So some people come say, oh, last year I got this much refund, this year I didn't get refund because your situation has changed. So always check with your CPAs, know during the year, don't get surprised by April 15th. So if you're making quarterly payments, there are two approaches for quarterly payments, especially for federal. So first option is you just want to be penalty proof. You have expect to make same kind of money, even higher compared to the last year, but it's in line. So your approach would be just you make 110% of the last year. For example, if you in 2024 your total tax was 10,000, as long as you pay 11,000 for the next year with the quarterly payment, you would be covered for the estimated payments. You don't pay any penalties, and then you pay the rest in April 15. That's the best strategy. And even if you make much more money in 2025, it's a good strategy. You just pay 110% of last year, you pay the difference at the latest time that you want in April 15. But let's say in 2024 was a exception. You made $1 million and then it's just a one-time thing. And you pay taxes, you're done. It's not a good approach to pay 110% of last year if you're not making that much money this year. So that time you need to project your income for 2025 and to make estimated payments based on the actual amount. As long as you pay estimated payments about 90% of your tax for this year, you don't pay any penalties either. So there are different approaches for making estimate payments. So just you need to know, you need to be in contact with your CPAs. You need to communicate your situation. Again, your CPA doesn't know if you have a good year. If they don't do your bookkeeping, they don't know if you have a good year or bad year. You need to communicate with them. CPAs usually do the penalty proof based on the last year. And if you're making less money and you make that much payments based on the last year, it's not a good strategy. So now the tax season over, there are three main areas that you need to think about. First is if you're overpaid your taxes, you have a lot of overpayments, you need to change your strategies. If you underpaid, you're surprised by April 15, you need to change your strategies. And then just see what areas you missed. Could you contribute more to your retirement? Did you miss the options to contribute, make more donations? All of these strategies you need to take a look, see what you did wrong or what did you do well, so you can keep doing it. So review your tax return if you're overpaid, underpaid, or there are some areas that you can focus on to improve your taxes for the next year. Thanks for listening to this podcast. Today we talked about what you need to do after tax season, what strategies you need to do for it next year. And if you have any questions, please send us an email on the helpdesk@alamircpas.com. Please like and subscribe and send a message if you have any questions.